So as we discussed in our last video, Wednesday the 10th of December was a big day for the markets, and the Fed cut their rates by 25 basis points, which is the third consecutive cut this year. Now the move was expected. The markets had already priced in a 96% probability of such a cut. However, the Fed's updated projections signaled only one further cut in 2026 and no rate hikes ahead. They emphasized caution moving forward. Now, there were 3 dissenting votes showing internal divisions, 1 for a larger cut and 2 against any cut at all. So why does this matter? Well, an expected cut is typically priced in before the meeting, which we knew, but the forward guidance is what is interesting. This often matters more than the cut itself, and Jerome Powell stressed that future rate hikes are not in the base case aligning with updated outlook. He also discussed economic uncertainties and the need to weigh inflation versus employment data before further easing. So overall, the message was dovish on the cuts, no hikes, but not ultra-dovish, and future cuts are uncertain. So you'll remember last time we visited the S&P 500, we were pushing into this clear area of supply, and the market hovered around that zone before the meeting. In fact, we tapped it, we rejected to the downside, then we rallied back in on the 10th. So the market reacted in a bullish fashion on the 10th, and it followed through all the way through to the next day on the 11th as well. But there's still indecision. The markets often prefer clear dovish guidance, so i.e. many cuts ahead. Tones like that will give the market clear direction, and that would typically weaken the dollar and lift risk assets like the S&P 500. But Powell's message was too mixed. It was dovish, but it was leaning into caution. It was not an unequivocal more cuts ahead soon. So where do we go from here? Well, this market has pushed into supply. It's trying to take the all-time highs. We had a big sell-off on the 12th of December, moved into a risk-off environment. Today, we're already seeing some more bullish momentum, so the buyers are taking control. Will this last? It all depends on whether the market feels like there's risk ahead, whether more cuts are likely, and there'll be a lot of dependency on the job numbers and inflation data. We have US CPI this week, so those figures could be very important for this market. Now, also last week, gold spiked quite heavily on Friday, so gold rallied sharply heading into and on Friday, approaching multi-week highs with a mix of a weaker US dollar, which we've already discussed, lower treasury yields, which happen post-Fed, which usually boost non-yielding gold, and positioning ahead of key macro data, i.e. the jobs figures. But as soon as we pushed into this technical area of supply, very similar to the S&P 500, we saw an instant sell-off. You can see on this daily candle on the 12th, we actually retraced a huge portion of the daily move. Why did this happen? Well, precious metals often show short-term volatility around big central bank moves. Where the bulls push prices towards technical extremes, then the short-term traders take profits as the initial euphoria fades. This fits the pattern where gold sees big intraday swings before settling. We did see some commentary from analysts on Friday, and they flagged that gold could be more volatile due to mixed drivers, with rallies powered by dovish central banks, but tempered by profit-taking and overbought technicals. This is all-time highs. Naturally, traders and people that understand how money moves aren't necessarily buying the all-time highs. They're waiting for those corrections and those pullbacks in the market, and that's why technically on Friday, we saw quite an extreme pullback into the close. So the week ahead is an extremely busy one for the markets. You can already see here from Tuesday, the news calendar gets very hot. We've got GBP claimant count change, we've got Euro PMI data, we've got Pound PMI data, and then that follows on into the afternoon with some big US data as well. Now, all these figures are really important, especially for the Fed and where they go with their rates moving forward. So the market will naturally be trying to price in the chance of future cuts. Wednesday, we see GBP CPI in the morning, but then Thursday is even busier. We've got the monetary policy for the pound, and we've also got the monetary policy for the euro. The subsequent meetings that follow, again, will tell us where these central banks are going with their rate cuts moving forward. Then 1:30 on Thursday, we've got CPI data for the US dollar. Again, a really big release, and it's likely to cause extreme volatility in the markets. And we round off the week with Friday, the Bank of Japan's policy. So we have several interest rate decisions and US dollar CPI this week. It's a huge week for markets. We're likely to see increased volatility. Let's see where we end up next week when we revisit the charts.